Hello friends, welcome to the YouTube channel of FinSim. My name is Raghu, a certified financial planner and founder of FinSim. While COVID-19 has taught a very important lesson to all of us, that's a need for having a term insurance cover to safeguard the future of our family members, individuals are making number of mistakes while buying the same. In this video, we have made a small effort to educate on the common mistakes which needs to be avoided while buying term insurance. Before we proceed further, a quick disclaimer. This is strictly for education purpose. Any company names we might mention is for reference purpose only. Please consult your financial planner before proceeding with any purchase. Views expressed in this video are based on our personal experience and analysis. Underinsurance is one of the most prominent mistakes which most individuals do. As per one of the survey done back in 2020, only 3 out of 10 insured individuals opt for term insurance. Even while buying a term insurance, individuals go with standard 1 crore or 1.5 crore of cover and do not really calculate the right amount of insurance coverage which is required for them. This is because of ignorance on the part of the insured and also partly due to the advertisements which portray 1 or 1.5 crore to be the standard insurance cover. Each individual's financial situation is different. So multiple factors needs to be taken into account before deciding on the insurance cover. I have listed some common factors for your reference. If the same standard of living needs to be maintained, one needs to determine the amount of monthly expenses incurred. After the unfortunate death of the insured, for how many number of years the term insurance amount should support the family needs to be determined. Inflation is going to play its role even after the death of the insured, which will result in raising monthly expenses for supporting the family. One can look at having the upper band of central bank's comfort zone. In case of RBI, it would be around 6%. Apart from monthly expenses, other financial goals like children's education or home loan or other loans should also be taken into account. Any existing financial assets of the insured plus existing insurance cover, excluding the insurance cover offered by the company. Ideal term insurance cover should be sufficient enough to help the family lead the same lifestyle even if the insured is not around. At the same time, long-term goals like kids' higher education should not get impacted. If an individual doesn't pay attention to these factors, he or she might end up availing a term insurance cover which might not need or which might not meet family needs completely. You can use our proprietary calculator to calculate the ideal insurance cover required by inputting your data. Link for the same will be provided in the description box of this video. Second most common mistake, which I see in my practice, is that individuals opt for hybrid term insurance options like return of premium option, wherein if the insured survives the period of term insurance, all the premiums which he or she would have paid will be refunded back. Second, individuals opting for paying premium for limited period of time, but the life cover will be available for a longer period of time. Example might be paying the premium for 5 years and life will be covered for 30 years. Third, combination of return of premium and limited pay option. Let me now explain why one should not avail such hybrid options with example. We will be looking at an individual aged 31 purchasing a term insurance cover for 1 crore rupees with a term of 29 years. If the insured were to choose plain vanilla term insurance contract where the premium needs to be paid for the whole 29 years and there won't be any return of premium if the insured survives after 29 years, then the premium would be around 14,624 rupees. If the insured chooses an option to get the premiums back after paying yearly premium for 29 years, premium amount would be around rupees 30,521 rupees, and Insured would receive 8.89 lakhs after 29 years. Last alternate option, which is famous as it is marketed by the insurance companies heavily, is where the insured will have to pay for 7 years and the life cover will be available for 29 years. In this case, the premium would be on the higher side, that is around rupees 42,244. Now that we know the premiums, let's compare the plain vanilla term insurance contract with other hybrid options. If the difference in premium and the return of premium option is invested in schemes providing a return of 7%, insured would have made 14.85 lakhs. Same at 12% would provide around 38.2 lakhs. And at 14% it will be around 56.55 lakhs. As against 8.89 lakh, which is refunded by the company after 29 years. Similarly, if the difference in premium under limited year premium option is invested in instruments which have the potential of providing either 7% or 12% or 14%, insured would have made 3.66 lakhs or 22.6 lakhs or 40.2 lakhs respectively. Conclusion: stick with the plain vanilla term insurance contract wherein the insured will have to pay premium for the whole period of term insurance contract. Third mistake is choosing the incorrect payout option. While the plain vanilla term insurance contract pays a lump sum amount on the unfortunate event of death of the insured, there are other payout options which have been made available by the insurance companies which comes with a reduced premium cost. Some of the options are periodic income or partial income plus periodic income or increasing income. It's advisable to opt for lump sum and ignore the other options. Inaccurate updating of proposal form. This is one of the primary reasons why insurance claims are rejected by insurance companies. Proposal form for term insurance coverage is pretty detailed and will try to collate numerous data points. This helps the underwriter in determining if the proposer needs to be provided with the cover and if yes, what should be the premium charged for the same. Some of the factors which will increase the premiums are consumption of tobacco in any form, consumption of alcohol, any pre-existing ailment, nature of job of the proposer. If accurate information is not provided by the proposer while availing the insurance cover, then the insurance company has the right to deny payment during the claim period. An example, if the insurer consumes tobacco or alcohol, but this fact has not been revealed in the proposal form. However, in the unfortunate event of death, if the medical report suggests presence of nicotine or alcohol in the body of the deceased, insurance companies have the right to deny the claim. Some other factors which might not increase the premium, however, the proposer needs to give accurate information relating to the same, are listed below. Income of the proposer, existing insurance policies of the proposer. Providing high importance to settlement ratio. During my interaction with the clients, I have seen most of the clients only looking at settlement ratio declared by the IRDAI on their website while determining which insurance company to select for availing term insurance cover. While this piece of information is an important parameter, one needs to understand how settlement ratio is calculated. Insurance companies issue various types of insurance policies and not just term insurance. Apart from term insurance policies, most of the other policies provide an insurance cover of around 10 to 12 times of the annual insurance premium amount. That is, for an annual premium of about 50,000, one can get an insurance cover of around 5 to 6 lakh rupees. Whereas with respect to term insurance, an individual age 25 can get a cover of around 1 crore rupees by paying as low as 12,000 or 15,000 rupees. When settlement ratio is calculated, both type of policies are given the same weightage, which is wrong according to us. It's advisable to look at multiple factors before finalizing on the insurance company for taking term insurance. We have listed some of them for you. 1. How long is the insurance company in business? 2. How many policies are being managed by the company? 3. What is the average amount per claim, which is a very important factor? 4. What is the solvency ratio of the company? We have done the exercise of calculating the average amount per claim for the top 10 life insurance companies operating in India. You can do a similar exercise by looking at the annual report which IRDAI publishes on their website. Not considering adding riders in the policy is another common mistake. Riders provide a cheaper way of increasing the insurance cover or cover multiple risk factors, but these aren't usually considered by the individuals. Adding some of these riders to the term insurance cover would be definitely helpful. Examples might be accidental death rider. Few individuals who spend good amount of time on the roads, they should definitely consider opting for this rider. Second example might be critical illness cover. While the medical insurance takes care of the medical expenses, critical illness cover provides a lump sum payment on the eventuality of an individual getting diagnosed with the listed critical illness in the policy, like cancer, heart attack, liver failure, disability, blindness, burn injuries, etc. Some of these critical illnesses can result in loss of income for some period of time. The lump sum received via this rider will assist the insured while dealing with this challenging phase of life. Last but not the least, purchasing insurance for an unreasonable period of time. Some individuals try to avail a term insurance policy till the age of 80 or 85, as the probability of an individual succumbing to death will go up with the increase in age. But one needs to consider the optimal time period for which the term insurance needs to be purchased. This will take us to the original question why one should avail term insurance. It's basically to provide financial assistance to dependents when an individual is not around. Next question is at what age an individual will not have financial dependence? By the age of 60 or 65, kids would have completed their education and would have become financially independent. Age of 60 or 65 is also most likely the retirement age of the insured. And if the insured has planned for his retirement either by himself or herself or by way of engaging a financial planner, sufficient retirement corpus would have been created to take care of him or her and spouse. So ideally, term insurance needs to be availed till the age of 60 or 65. Once again, there can be exceptions to this rule, and your financial planner would be the best person to advise you in this regard. If an individual is looking at term insurance from the perspective of leaving a legacy for the next generation, here is the calculation which shows that instead of purchasing a term insurance for 85 years, individuals can look at investing the same to accumulate wealth which can be passed on to the next generation. We have taken an example of a male aged 32 years opting for term insurance coverage of 1 crore. If he were to choose the cover of 65 years, he will have to pay a premium of 17,242 rupees. And if he chooses 85 years, then the premium raises to 26,883 rupees. The difference in premium is around 9,641. If this difference amount is invested in an investment vehicle providing 10%, he can accumulate around 1.64 crores. Same at 12% results in a corpus of 3.64 crores. And at 14%, he would have accumulated 8.13 crores. Next question would be, is it possible to achieve this kind of returns? Yes, I have taken the average returns which the broad categories like large, mid, and small caps have generated over the past 10 years. And as you see, it's around 13.7%, 19%, and 19.7% respectively. Finally, it's advisable to use life insurance only for the purpose of managing one's risk and not for wealth creation. We hope you found this video useful. India's financial literacy rate is around 27%, whereas the developed economies are standing at around 60%. We have made an effort from our end by sharing relevant information in this video to educate our fellow Indians. Please help us in spreading financial literacy by subscribing to our channel and sharing this video with your friends and family and help them in becoming financially literate. Together, we can help India move towards becoming a developed nation. For a free consultation on how we can assist you in achieving your financial goals, please reach out to us on the mobile number and email address displayed on the screen. Thank you